Are you a young professional who wants to retire early or generate wealth, but you are being held back from investing in the stock market? In recent years, more people have realized that the secret to financial stability and freedom is investing. So, keep watching till the end of this video because number 9 will teach you how to become confident in the stock market. Number 1. Invest in your knowledge. If you don't want to lose all your money, study the risks associated with investments and gather as much information about how the stock market works. Not only that, but studying the companies you want to invest in and how certain economic and technical factors will affect that company's stocks will benefit you in the long run. Research and employ strategies that you think are most compatible with your goal. Remember, your investing journey doesn't start and end with you investing money. This journey also involves investing in knowledge. Some educational websites that Forbes Finance Council suggests for newcomers to the stock market include NerdWallet, the SEC website, Yahoo Finance, and Investopedia. And according to Yahoo Finance, one of the best ways to know if a stock market or stock company is worth investing in is by looking into its management. Gauge if it is a well-managed company that has both potential and stability. Can it bounce back from a major dip in its value? Number 2. Focus on the long term. Most people have its misconception that investments immediately yield results when in reality, it takes a long time to create an investment portfolio that will give you a stable flow of money. Remember, even though the stock market is a relatively safe and minimal risk place for investments, it is still not zero risk. According to Investopedia, one of the many advantages to the long-term holding of your investment is that it significantly reduces your tax liability and the amount of money you spend on transaction charges. Investopedia also emphasizes that most investors are emotional investors who sell their stocks immediately when they see the market turn sour. This impulse or this fear will only hinder your success because fluctuations are short-lived, and the buy-and-hold strategy will yield better results. The get-rich-fast mindset often leads people to make impulsive decisions that do more harm than good, like investing all their funds and savings into singular investments, hoping it will make them rich within a few months. Number 3. Diversify your portfolio. One thing you should understand regarding the stock market is that the value of the stocks fluctuates. The value of your stock investments is volatile, and it can quickly go up or down depending on several factors. This is a lesson that business magnate and one of the world's richest people, Jeff Bezos, continues to teach. Bezos stated, "If you invest and don't diversify, you're literally throwing out money." People don't realize that diversification is beneficial even if it reduces your return. Why? Because it reduces your risk even more. Investing your money in different companies or stocks means that even if one of those companies suffers a loss, you will have other investments to fall back to and a guarantee that you will not be losing all your money. Number 4. Buy stocks at the right time. Another common mistake made by most people new to investing is going with what's trendy and buying company stocks at the peak of its popularity. If you do this, you'll buy said stocks at their highest price, and when the hype around is gone, your investment's value will also go down. Learn how to analyze the market prices to determine whether a stock is overvalued. One way to do this is to use the price-to-earnings or PE ratio. This analysis would relate the current share price to the stock's earnings per share. The formula would be PE ratio is equal to earnings per share divided by market value per share. A high PE ratio means this stock is overvalued, and its value will probably die down or gradually go down instead of going up. Number 5. Preparing yourself. Making mistakes is inevitable, and you are bound to cause some throughout your investment journey. If you notice that some of your stocks is losing more and more money, then the best course of action is to take the L. Cut your losses and let it go. American author of the successful finance book, One Up on Wall Street, Peter Lynch, always says, "You get recession, you get stock market declines. If you don't understand that's going to happen, then you are not ready and you will not do well in the markets." Number 6. Never risk too much money. The money you should be investing in the stock market or any kind of investment should come from your disposable income. Some people take out loans and use rent money or their entire life savings as capital for their investments. Do not do this. This is an easy way to get yourself into crippling debt. Investments should come from your extra money or money that won't affect your financial stability if it suffers a loss. New York Times best-selling author Suze Orman states that the best way to handle your finances is never to invest the money you might need within a year. If the money you plan on investing comes from the money you won't need in the next 7 years, then you're good to invest it. Remember, you can't invest only a single dollar and then expect millions of dollars in return. Number 7. Don't make decisions emotionally. Although this step is usually heard when doing short-term trading, this can also be applied to long-term investing. And this can be seen during the height of the pandemic. According to 𝐉𝐻𝐈𝐍, many experts predict that the entire market would suffer a major dip in value across all companies. But seeing that the stock market is at an all-time high, we now know that this prediction was wrong. While the market did suffer a blow initially, just like any other major fluctuations in value, this major dip during the pandemic was short-lived. Now, all of the people who sold their stocks during the pandemic out of fear are now regretting this. Number 8. Short-term trading isn't worth it. Short-term trading means that you have to monitor the movement of the stock market almost 24/7 to buy stocks at a lower price and then immediately sell them when the stock reaches a certain higher value. Short-term trading isn't for you if you are not a professional stock trader. According to Markets Insider, almost 80% of users from the trading platform eToro lose money over 12 months, while a study done by the U.S. Securities and Exchange Commissions of Forex traders found that 70% of traders will lose 100% of their money within 12 months. Investment analyst Sean Bendazian says, "The reality is you only hear the success stories. People should understand that there are exponentially more people that lose money trying to catch lightning in a bottle. Some people indeed succeed in this strategy, but that is not the case for most people." Number 9. Practice with a stock simulator. Many people think investing in the stock market is easy. That is until they start investing and realize that it is more complex than they thought and they must use strategies to maximize their earning potential. There are a lot of available websites where you can practice investing in or trading stocks by using fake virtual money for free. Practicing within a simulator will give you a better understanding of how the actual process and how the stock market prices work before you move on to investing real money. There are countless of free stock market simulators such as the Stock Market Game, a trading simulator catering to mostly young students and beginners, where you will be given $100,000 investment portfolio to experiment or trade with. Or, if you want to trade in live futures markets with real market data and an easy interface to understand, the CME trading platform also offers its own simulator. Number 10. The perfect time to start is now. This last step doesn't necessarily mean that you should start investing money and buy a stock right now. It starts with educating yourself and planning your goals for the future of your stock market investment. Many people hesitate and are waiting for the right time to start investing when in reality, there is no objectively perfect way to start. And just like what famous Shark Tank investor Barbara Kerr said, finding opportunity is a matter of believing it's there. You don't have to look for an opportunity to start because it has always been there. I hope you found these tips useful, and if you have more tips to share, let me know in the comments section below.